Hey everyone, welcome back to Corporate Decoder, the place where we untangle those confusing corporate filings. Ever wonder what companies are really saying? Today we're diving into WEC Energy Group's proxy statement. And trust me, even a document about meetings can have some surprises hidden inside. It's like finding out your quiet neighbor is secretly a world-class salsa dancer. This document is an invite to the annual meeting, but also a peek behind the curtain of how the company is run. It's not just about boardroom talk. It outlines what the company did last year, what they plan for the future, and who's calling the shots. Think of it like a school yearbook, but for a multi-billion-dollar energy company. First things first, WEC wants you to know they had a pretty good year. They are bragging about how they made more money and increased the dividend, which is the quarterly payment to shareholders. Plus, they got added to some fancy index, S&P one, which basically shows that they are returning a lot of cash to their investors. But it's not all sunshine. WEC is planning to spend a whopping $28 billion over the next 5 years on infrastructure. That's a lot of money. They say it's to keep things safe, reliable, and to grow the business. But that kind of investment also impacts energy bills and potentially the company's debt. The board got a makeover too. 2 new directors are joining, Warner Baxter and John Lang. The company is confident these directors will add expertise to the leadership, but a shake-up in leadership can also lead to different strategic directions that might not always work out. One of the key things you'll be voting on is whether to approve the way executives are being paid. It's called an advisory vote, so it's not binding, but the board pays attention to what the shareholders think. It is basically a temperature check on how they're running the business. The filing mentions a lot about the company's focus on what they consider fundamentals: safety, reliability, customer happiness, financial responsibility, and being environmentally conscious. These goals might seem obvious, but are also targets used to determine executive compensation. A big part of how executives get paid is linked to these fundamentals, especially anything related to safety, customer happiness, and diversity goals. However, this has also been linked with the company's ability to effectively fund its capital plan through funding of their financial plan, through financial metrics used in the company's compensation program. Now, onto the environmental stuff. WEC is talking big about a clean energy future. Their 5-year plan includes major investments in renewable energy and infrastructure, aiming for big reductions in carbon and methane emissions. They want to reduce emissions by 60% in the next few years, aiming for total carbon neutrality by 2050. The board is also focused on making the company more transparent, including more public disclosures of information that is of interest to its shareholders and customers. Let's talk about the people in charge. The filing emphasizes that most of the board members are independent, meaning they are not company employees and should make decisions in the best interest of the shareholders. All of the board nominees, other than a non-executive chairman and the CEO, were independent. It then proceeds to spend a lot of sentences on justifying why a director that has connections to other financial groups and vendors used by WEC are independent. The board has a process for picking new people, including getting recommendations from stockholders. That being said, the board added 6 new independent directors in the last few years. Risk management is a big deal because, energy companies can be risky. WEC has an enterprise risk steering committee plus a separate committee dedicated to climate change. They have a cybersecurity governance model in place, meaning there's a plan to avoid a digital disaster. Board members show up to meetings too. The attendance rate was super high, over 98%. Also, at each meeting, the independent directors have a private chat where they can speak freely. The board does also evaluate how they are all doing and the CEO performance. Each director gives their feedback and then the lead director shares it to the CEO. Let's peek into the compensation committee, the group in charge of paying the top dogs. They use an outside consultant to help them figure out what's fair, and they look at what other similar companies are paying their executives. Time for some auditing. You're being asked to approve Deloitte and Touchel as the company's independent auditors for next year. They've been doing it for 22 years. So the board is requesting you let Deloitte keep their job. The recommendation by the board is to keep them since they know the ins and outs of the business, so it saves a lot of headache and money from hiring someone else. How much does this auditing cost? Well, the audit fees are almost $7 million. There's also a little bit of tax work and some other fees, but the audit is the big one. Here comes the juicy part, how much the top executives are making. The goal of their pay package, according to the report, is to be competitive. Reward executives for hitting short and long-term goals and align the executives' interests with those of the shareholders and customers. It mentions that a huge part of compensation is all dependent on performance and isn't guaranteed to the executives if certain things aren't achieved. In order to make sure the compensation is in line, the Compensation Committee uses a combination of surveys from compensation groups and data from 20 other similar companies to determine market median. The CEO's base salary was a bit over $1.1 million. It was increased 5% compared to last year. The salaries of the other top executives are generally near what the average market salary is for similar positions in other companies. A large part of the executive's bonus depends on how well the company did against preset goals. These are in areas like customer satisfaction, safety, diversity, and finance. If the targets aren't met, executives don't get the full bonus. The 5-year capital plan is a big one because it plans significant investments to modernize infrastructure and the transition to low and no carbon generation, all aimed at reducing carbon emissions. In simple words, they want to hold the executives accountable to how they are planning to reach their low and no carbon investment goals. Because of this, the executives are financially incentivized to move towards carbon neutrality. A portion of the long-term incentive awards depends on how the company's stock performs compared to a custom group of other similar companies. In other words, do the shareholders see a return on their investment compared to if the shareholders invested in a similar company? This is a significant chunk of the executive's potential pay. Executives are required to own a certain amount of company stock, so they are more aligned with how well the company is doing, just like normal shareholders. Now, we're at the things shareholders will be voting on. One is eliminating supermajority voting requirements. This is where it gets a little inside baseball, basically. Some decisions need a huge percentage of shareholder votes to pass. Now, WEC is asking to lower that threshold to just a simple majority so it's easier for shareholders to make big changes. In addition to the changes with restated articles, this is also similar to the above proposal, but to the company's bylaws instead of the articles. There's also a deadline if you want to nominate someone for the board or make a proposal at the next meeting. Mark those calendars for next November. Finally, let's see who the big bosses are when it comes to owning the company. Vanguard, BlackRock, and State Street Corporation are the major stockholders. What this says is that it's primarily owned by institutions rather than individual investors. So what's the real story here? WS Energy Group seems to be positioning itself for long-term growth while still trying to keep shareholders happy. They are juggling a lot of things: big spending on infrastructure, a shift to cleaner energy, and keeping the executives paid well enough to stay motivated. A strength here is the company's commitment to transition and clean energy. Their large capital plan signals their commitment to a carbon-free future. That said, they are spending a lot of money in a short period of time. This could lead to debt issues and is worth keeping an eye on. What does it all mean? The fact that it's mostly held by the big three investment institutions puts pressure on environmental and social concerns, making investment choices heavily tied to ESG metrics. Thanks for watching. Don't forget to like, comment, and subscribe for more corporate decoder videos. Let me know in the comments what company you want us to decode next.